CIBS 2011 Top 15 list of easiest countries in which to do business. Each year, World Bank rates 183 plus countries on ease of doing business for foreign companies. The overall ease of doing business score is based on how easy it is to start a business, deal with construction permits, register property, get credit, protect investors, pay taxes, trade across its borders, enforce contracts, and close a business. This explains the system by which they establish the ease of doing business ranking for each country. The Ease of Doing Business Index ranks economies from 1 to 183. For each economy, the index is calculated as the ranking on a simple average of its percentile rankings on each of the 9 topics. The ranking on each topic is a simple average of the percentile rankings on its component indicators. If an economy has no laws or regulations covering a specific area, for example, bankruptcy, it receives a no practice mark. Similarly, an economy receives a no practice or not possible mark if regulation exists but is never used in practice, or if a competing regulation prohibits such practice. Either way, a no practice mark puts the economy at the bottom of the ranking on that relevant indicator. Here is one example of how the ranking is constructed. In Iceland, it takes 5 procedures, 5 days, and 2.3% of annual income per capita in fees to open a business. The minimum capital required amounts to 11.97% of income per capita. On these 4 indicators, Iceland ranks in the 13th, 4th, 15th, and 63rd percentiles. So on average, Iceland ranks in the 24th percentile on the ease of starting a business. It ranks in the 50th percentile on protecting investors, 40th percentile on trading across borders, 10th percentile on enforcing contracts, 9th percentile on closing a business, and so on. Higher rankings indicate simpler regulation and stronger protection of property rights. The simple average of Iceland's percentile rankings on all topics is 25%. When all economies are ordered by their average percentile rank, Iceland is in 15th place. More complex aggregation methods, such as principal components and unobserved components, yield a nearly identical ranking. The choice of aggregation method has little influence on the rankings because the 9 sets of indicators provide sufficiently broad coverage across topics. So doing business uses the simplest method. The Ease of Doing Business Index is limited in scope. It does not account for an economy's proximity to large markets, the quality of its infrastructure services, other than services related to trading across the borders, the strength of its financial system, the security of property from theft and looting, its macroeconomic conditions, or the strength of underlying institutions. There remains a large unfinished agenda for research into what regulation constitutes binding constraints, what package of reforms is most effective, and how these issues are shaped by the context in an economy. The Doing Business indicators provide a new empirical data set that may improve understanding of these issues. Doing Business 2011 also uses a simple method to calculate which economies improve the most on the ease of doing business. First, it selects the economies that reform in 3 or more of the 9 topics included in each year's Ease of Doing Business ranking. 25 economies met this criterion for 2011: Belarus, Brunei, Darussalam, Burkina Faso, Cape Verde, the Democratic Republic of Congo, Georgia, Grenada, Guyana, Hungary, Indonesia, and the Islamic Republic of Iran, Kazakhstan, Lithuania, Mali, Montenegro, Peru, Rwanda, Saudi Arabia, Sierra Leone, Slovenia, Sweden, Tajikistan, Ukraine, Vietnam, and Zambia. Second, Doing Business ranks these economies on the increase in their ranking on the ease of doing business from the previous year using comparable rankings. Following are business snapshots of the top 15 countries. Singapore. Singapore has a highly developed market-based economy based historically on extended entrepreneur trade. Along with Hong Kong, South Korea, and Taiwan, Singapore is one of the 4 Asian tigers. The economy depends heavily on exports and refining imported goods, especially in manufacturing, which constituted 26% of Singapore's GDP in 2005, and includes significant electronics, petroleum refining, chemicals, mechanical engineering, and biomedical science sectors. Hong Kong. As one of the world's leading international financial centers, Hong Kong has a major capitalist service economy characterized by low taxation and free trade, and the currency, Hong Kong dollar, is the 9th most traded currency in the world. It maintains a highly developed capitalist economy, ranked the freest in the world by the Index of Economic Freedom for 15 consecutive years. New Zealand. New Zealand has a modern, prosperous, and developed market economy with an estimated gross domestic product and purchasing power parity per capita of roughly $28,250 US. New England was ranked the third most developed country in 2010 according to the United Nations Development Programme's Human Development Index, and fourth in the 2011 Index of Economic Freedom published by the Heritage Foundation. United Kingdom. The UK has partially regulated free market economy. Based on market exchange rates, the UK is today the sixth largest economy in the world and the third largest in Europe after Germany and France. The UK economy has been managed in accordance with principles of market liberalization and low taxation and regulation. The United States has a capitalistic mixed economy which is fueled by abundant natural resources, a well-developed infrastructure, and high productivity. The United States is the largest importer of goods and third largest exporter. Denmark's mixed economy features above average European living standards and high amount of free trade. Denmark ranks 16th in the world in terms of GDP per capita and ranks 5th in the nominal GDP per capita. Denmark has the most flexible labor market in Europe. Canada is one of the world's wealthiest nations with a high per capita income. It is one of the world's top 10 trading nations. Canada is a mixed market ranking above the U.S. on the Heritage Foundation's Index of Economic Freedom and higher than most Western European nations. Norway. Norwegians enjoy the second highest GDP per capita after Luxembourg and fourth highest PPP per capita in the world. Today, Norway ranks as the second wealthiest country in the world in monetary value, with the largest capital reserve per capita of any nation. Ireland. Despite the fact that Ireland has never really industrialized, in 2005 it was ranked the best place to live in the world according to a quality of life assessment by The Economist magazine. The Republic of Ireland joined the euro in 1999. Australia has a free market economy with high GDP per capita and low rate of poverty. After the 2006 merger of the Australian Stock Exchange and Sydney Futures Exchange, the Australian Securities Exchange is now the 9th largest in the world. Ranked third in the Index of Economic Freedom, Australia is the world's 13th largest economy and has the 9th highest per capita GDP. Saudi Arabia's command economy is petroleum-based. Roughly 75% of budget revenues and 90% of export earnings come from the oil industry. The oil industry comprises about 45% of Saudi Arabia's gross domestic product. Saudi Arabia has promoted growth in the private sector by privatizing industries such as power and telecommunications. Georgia. For much of the 20th century, Georgia's economy was within the Soviet model of command economy. Since the fall of the USSR in 1991, Georgia embarked on a major structural reform designed to transition to a free market economy. Georgia is becoming more integrated into the global trading network. Its 2006 imports and exports accounted for 10% and 18% of GDP, respectively. Finland has a high industrialized mixed economy with a per capita output equal to that of other European countries such as France, Germany, Belgium, and the UK. The largest sector of the economy is services at 66%, followed by manufacturing and refining at 31%. Primary production is 2.9%. With respect to foreign trade, the key economic sector is manufacturing. Sweden is an export-oriented mixed economy featuring a modern distribution system, excellent internal and external communications, and a skilled labor force. Timber, hydropower, and iron ore constitute the resource base of an economy heavily oriented toward foreign trade. Sweden's engineering sector accounts for 50% of output and exports. Iceland. In 2007, Iceland was the 7th most productive country in the world per capita and the 5th most productive by GDP at purchasing power parity. Except for its abundant hydroelectric and geothermal power, Iceland lacks natural resources. Historically, its economy depended heavily on fishing, which still provides 40% of export earnings and employs 7% of the workforce. Thank you to International Finance Corporation, the World Bank, and Wikipedia for supplying this information. This concludes Business Training's videos module World Bank's 2011 Top 15 list of easiest countries in which to do business. Thank you.